Everyone wants passive income, money that comes in every month without you having to trade your time for it. But here's the truth. Not all passive income is really passive, and not all investments that promise steady returns are sustainable. In today's video, we're going to break down some of the best real estate funds in the US, the ones that actually pay consistent monthly income and can also grow in value over time. Whether you're looking for stability, long-term growth, or higher yields, I'll show you what to look for and what to avoid. Welcome to Money IQ, where we make smart money simple. Before jumping into specific names, let's quickly understand what these funds are. REITs, real estate investment trusts, are companies that own or finance income-producing real estate. Think of them as mutual funds for properties. Instead of buying a single building, you buy shares of a company that owns hundreds of them. Here's the key. By law, REITs must pay at least 90% of their taxable income as dividends to shareholders. That's why they're so popular among investors who want regular cash flow, often paid monthly or quarterly. Now, before you put your money into any real estate fund, there are 5 important things to analyze. Dividend yield, how much you earn per year from dividends. A healthy range is usually between 4% and 8% annually for most solid REITs. Consistency of payments, monthly versus quarterly, and how stable those payments have been over time. Portfolio quality, what kind of properties the fund owns. Residential, commercial, warehouses, healthcare, data centers, even movie theaters. Leverage, too much debt can destroy returns when interest rates rise. Sustainability, make sure the dividend is supported by real income, not just short-term borrowing. Understanding these factors helps you separate stable income funds from those that look profitable but carry hidden risks. And now let's look at some of the most respected and high-yielding real estate funds available today. First, Realty Income, ticker O, known as the Monthly Dividend Company. This REIT pays dividends every single month with a track record of over 25 years of continuous growth. It owns thousands of commercial properties leased to big brands like Walgreens, 7-Eleven, and FedEx. Yield, around 5 to 6% annually, and not the highest, but one of the most reliable. If you want peace of mind and consistent monthly income, Realty Income is a solid choice. Second, EPR Properties, EPR. This one focuses on experiential real estate. Think movie theaters, ski resorts, and family entertainment centers. It currently offers a 6 to 7% yield paid monthly. The risk here? It depends heavily on how strong consumer spending is. If people go out and enjoy experiences, EPR thrives, but during economic slowdowns it can suffer. Third, ARMOR Residential REIT, ARR. Now this one is for investors who can handle a bit more risk. ARMOR invests mainly in mortgage-backed securities, meaning it earns money from home loans. Because of that, its yield can reach 15–20% in certain periods. But remember, high yield always comes with high volatility. If interest rates rise, the stock price can drop sharply. Fourth, Orchid Island Capital, ORC. Another mortgage REIT with extremely high yields, also around 18–20% at times. It's attractive for short-term income, but the price can fluctuate a lot. This is not for conservative investors. It's for those chasing aggressive monthly returns. Fifth, REIT ETF, Hoja Capital High Dividend Yield ETF. If you prefer diversification, REIT is a great choice. It's an ETF, meaning it owns dozens of different REITs, so your risk is spread out. It pays a monthly dividend around 9 to 10% annually, and you can buy it directly from most US brokers. For beginners, this is one of the easiest ways to get exposure to real estate without managing individual REITs. If you want stable income, focus on companies like Realty Income or EPR. They won't make you rich overnight, but they're built for consistency. If you're willing to take more risk for higher monthly cash flow, then ARR or ORC might fit, but only as a small portion of your portfolio. And for balanced diversification, a fund like REIT ETF can give you both income and exposure across multiple property sectors. So, to sum it up, real estate funds can be one of the most powerful ways to build true passive income, especially in the US market. But always remember, stable returns matter more than high returns that disappear overnight. If you got value from this video, give it a thumbs up, subscribe to Money IQ, and turn on notifications. Because next week I'll show you how to build a $1,000 per month income stream with just a few smart ETFs. Thanks for watching, and keep growing your Money IQ.